In this segment, we're going to cover the Berkridge Group, how it works, a few structures. We'll look at some case studies, different applications, and what to look out for when you're out in the field prospecting, and once you find them, what the next steps are in the process. So we are, again, a boutique investment bank. We arrange for capital to be deposited inside clients' life insurance policies. We fund premiums, 50,000 to a few $1,000,000 of annual premium. Sometimes we will fund these premiums up front, raise all the money up front and put it into the policy in the form of a single pay or other methods to do that. Now, we do use, there are some complications surrounding this. That's why we do have attorneys on staff that work on every one of these transactions, drafting the trust. Some of these trusts are relatively sophisticated, or structuring it through business entity for asset protection, different ownership reasons, flexibility, or if the client wants a service interest, they can do that and potentially receive a tax deduction in doing it. But the bottom line is we try to exploit the discount inherent in life insurance policies, and our underlying philosophy is to reduce a complex legal and tax transaction into its most basic elements. Nor would a confused client be able to really see the benefits in doing what we do. We do this all for the client's behalf. We show the clients the facts, we raise awareness, and we really reveal the secrets of the life insurance industry. A lot of the things the life insurance companies aren't telling us as advisors, aren't telling our clients as the end consumers. And we start with a really basic example, the art of buying. How do we buy anything in this world? We either pay cash or we use credit. The breakfast this morning, the dinner we'll have tonight, or nice cars, boats, real estate. Let's look at real estate as an example here. It's a great example. Let's look at how do we buy this $2 million estate here in Fairbanks Ranch? Are we going to finance, mortgage the purchase? And if we took away the option of finance, right, this is an analogy, it gets clients to understand what it is that our value add is. And let's look at this real estate analogy in a little bit more detail here, but still very simplified. This is option one, $2 million of cash to purchase that house. Option two, financing at a 3% interest rate fixed. Let's look at this over a 10-year period. Paying $60,000 a year versus the lump sum deposit. Remember, our money is typically doing something for us. Look at the retained capital, the opportunity gained in financing versus paying cash. In this example, we're looking at 1.94 million, 1.88, etc., and those numbers dwindling down over time as we continue to service interest here in the second column. However, the reality of it is we're taking those funds, we're reinvesting, we're doing something with it. Right? Our clients say we're putting them back, those funds back into their business, back into their portfolio, whatever it is. Assume they're yielding a rate of return of 5%, annually compounded. And over 10 years' time, without taking into account any discounts, we're ahead $560,000. So this illustrates the reason why sometimes, even if we had the cash up front to purchase that $2 million home, we finance, we take it a mortgage as opposed to paying cash out of pocket. Opportunity gained versus opportunity lost. We take that very same approach of leverage and we apply it to life insurance as an asset class. It just so happens that the life insurance policies, we look at them as an asset, we can purchase them for a roughly 70 to 80% discount. And like this example here, our clients may not even have the cash up front to properly fund this life insurance policy purchase. So all they need to do is service interest, or some of our clients, they're not even paying that interest. They're rolling that interest into loan. They're deferring it over time. So how do we win with our strategies? How do our clients win with our strategies where they're saving a lot of money and our policies have a 92% persistency rate over 10 years. That means they stay on the books. These are policies that are going to pay a death claim. And we win by properly funding the life insurance policy from the beginning. And if you remember, just like anything else in the world, we're typically either paying with cash or we're using borrowed funds. And in our strategies, our clients are using borrowed funds. We're providing them access to this capital to fund those life insurance premiums so they don't have to. They can leverage a lender's capital and they can retain use of their own capital for investment opportunities. So this is one of a set of two examples I'm going to show you on more specifically how this works in different ownership structures. So we typically have an insurance trust. Our attorneys usually draft this insurance trust. It's going to own the life insurance policy. We're going to fund all of the life insurance premiums through the trust to the insurance company. Okay. This trust is going to be applying for the funding as well as going to be applying for the insurance policy. Okay, the clients don't apply, but the trust applies for it. The clients can dictate who their beneficiaries are, their children, could be philanthropic reasons, whatever causes that they have a history of giving to. Okay, and the client is going to be really standing back and dictating where they want these funds to go, et cetera, et cetera, et cetera. We work with them on that. And the beneficiaries receive the net death benefit of the life insurance policy when they pass away, when our client passes away. So pretty simple. Client, the advisors back here helping quarterback everything, working with us, working with the client. Our attorneys draft the trust, and we go ahead, we fund and place these life insurance premiums, and the client can service interest in any year if they like. Here's an example using an irrevocable life insurance trust. So our client's going to be the grantor establishing the life insurance trust. Irrevocable life insurance trust is going to hold a life insurance policy outside of the client's estate, free of estate taxes, and it gives them a little bit more asset protection than does the other scenario I mentioned. We're going to be funding premiums through the life insurance trust directly to the life insurance carrier. Now, we need to get repaid. The money we put in plus interest. If the client is not paying interest, they're deferring interest, so the client's realizing zero out-of-pocket cost up front, they're going to have to repay us in some way, shape, or form. So we either get repaid when the client passes away, we get repaid before the beneficiaries get paid. Let's say it's a $5 million policy. We put $1 million in and we have $500,000 of unpaid interest outstanding. We go ahead and get our principal plus that interest back. The net death benefit, $3.5 million or so, goes to the beneficiaries. And that is really the simplified version of our most standard planning. There's a variety of other planning involving business entities and the like. We'll actually go over a few of those case studies. So how it works, the parties involved, we have an insurance carrier, we have trust documents, and then we have our funding mechanisms. And what's our client profile here? We like saying the healthy, wealthy, and the wise. We do need clients with a net worth of $1 million and greater. What exactly does that mean? Now, when we look at net worth, we pull all of their assets, personal and business related. We put them all together, including their primary residence. So we may have a client that, say, has $1 million house that they owe $500,000 on. They may have some fund, like qualified funds, say a few $100,000 there. They may have some unqualified funds, perhaps marketable securities. They may own a rental properties. They may own a business. Now, one of the things that we do, we have a CPA on staff. He performs a free, no cost to the client, personal financial statement, verifies it on his letterhead for our clients. And it shows really what their assets, what their liability makeup is, what their makeup of assets are. And he also does business valuations at no cost to our clients as well. We may have a client that, say, owns a gas station or owns some sort of company, manufacturing, whatever it is. We'll look at it based off of reasonable multipliers and valuation metrics. We'll determine how much that business is worth. Now, all of that, the purpose for all that is We have some individuals, some advisors that believe their clients may not qualify, or maybe they're on the cusp or it's marginal. When we really need all the facts. We look at everything and we can make a determination pretty quick, usually within 24 hours, of is this a qualifying candidate or not. Age 18 to 85, we have gone younger. We've also gone older. When we get into the really more and more mature ages, the insurance underwriting becomes rather difficult. Clients may have more medical conditions, or the cost of insurance might be rather high. We get asked often, what is the sweet spot? What's the perfect age? And there really isn't one. It really depends on the client's needs. All of these plans are very, very custom tailored. If you recall from the first video, the life insurance industry video, there's only about 600 of these transactions that occur on an annual basis. Fraction of the life insurance industry, and there is more capacity for them. So you got the very, very specifically. Business owners, doctors, attorneys, nonprofit groups. We can also fund group policies as well, and more of that will be in the prospecting section as well, which is a separate video. Nuts and bolts. We have two pieces. We have life insurance policy chassis, and then we also have our loan chassis. So we're funding permanent life insurance policies, either whole life policies, index universal life policies, current assumption universal life policies. We also have fee-based and low-load options, and we can also do survivorship policies. So really, any kind of permanent life insurance policy. And we can help with all the processing, case processing. We have case managers. We do all of that. Our bar available, true bank fixed rates, floating rates with a cap, whatever the client would like. And really, it's cash secure lending. So our rate terms are, they're very, very fair. We structure them specifically for that particular client, and we do all of really the negotiating and putting all these pieces together for our advisors and our clients. So really, we just need a client that could potentially benefit from these services, and we facilitate the entire transaction from start to finish. It really is a white glove treatment. So a lot of these insurance policies where we've been seeing over the past few years come with bundled options. They come with long-term care benefits. And some of them have really high accumulation potential. So when we're putting the maximum non-MEC premium in these policies for 5 to 7 years, we really see a jump start in funding. So we have clients that are supplement their retirement income, huge upside potential. We have clients that are looking for these plans for retirement, for death benefit, and also for the living benefits, for long-term care. Some plans cover critical illness or chronic illness, and that also applies to business insurance, to partnerships. And we'll show a buy-sell case example. As I mentioned, loan options, very, very flexible. We have everything available. Floating rates with a cap, true bank fixed rates. We can peg to either 30-day, 1-year LIBOR or and it is cash secured lending. So we are really the ones putting all these pieces together here. So how do we repay the loan? And we understand the trust or whatever entity is owning this is technically applying on life insurance premiums. Once the premiums are in there, that's great because the policy is issued, so there's death benefit, and there's cash accumulation. But that premium finance, the outstanding loan, how do we repay it? Well, typically one of 3 ways. What we see oftentimes is clients are planning benefit of the policy. Remember, we have an inherent discount of these policies, as the life insurance industry video reveals. Around 80% of them or so never pay a death claim. So for $1 million, you could buy a $5 million policy. Now, in our scenarios, we're structuring the funding for the $1 million. So the client never had to put in the $1 million, and say we're charging the client a 3% interest rate, and say they have a life expectancy of 20 years. Well, over time, let's imagine that principal, $1 million plus unpaid interest, grows to, let's say, even $2 million. When the client passes away, there's $3 million that they didn't have to pay for that's going to go to their beneficiaries by way of the trust. So that's one example. Another example is for really young clients, cash accumulation of these policies is so it's so fast, it grows so much that we can actually repay the outstanding loan from the cash value itself, all of it or a portion of it. And we have some clients that will liquidate an asset. They may sell a business, whatever the case is, and they can repay the outstanding premium finance loan from that as well. Determining borrowing rates. We'll look at 1-year LIBOR from 2003 to 2013. This is what it was. Different reset dates in January. And we'll look at that 10-year average of 2.43%, plus a spread of 150 basis points, sub 4%. If we're structuring a rate using 1-year LIBOR, a floating rate plus a spread, we're typically going to put a floor on the rate. In this example, the floor is 2%, and we're going to put a cap on the rate. In this example, the cap is 6%. So we get the best of both worlds. We can enjoy cheap rates today, and we're hedged against a rising rate environment in the future. And we always stress test our rates. In this example, moving along the yield curve, we're stress testing this rate to increase as 1-year LIBOR is anticipated to increase over time. There's a lot of analysis that goes into all this. Again, we see this on a daily basis. We're about 10 to 15% of the overall marketplace in any given year. So we do see a lot of these transactions, and they're all very, very customized, very custom tailored. From a financing incentive, why would we want to engage? Well, it's fully cash secured credit. A lot of it doesn't correlate with other lending, so it's a great diversification tool. And if the client passes away prematurely, we get repaid from the death benefit. So we have that. We're not going to sit on an asset and then be forced to liquidate it in a fire sale. So fully cash secured, lots of lending options and platforms available. And we'll go into one of our examples here of how do you fund a life insurance policy that's owned inside of an irrevocable life insurance trust. One way is to pay gift taxes. You really just pay gift taxes up front. Writing a check for premiums, gift taxes owed based on the amount applied to insurance. Another way is to lend using a grantor loan or taking a loan to make to the trust. Typically we use AFR rates. Gift taxes may still apply, and there really still is interest rate risk in this scenario. And we do all the structuring and analysis on the back end. A third option is to borrow using bank financing. And in bank financing, we're borrowing funds from a lender, this is what we do here at the Berkridge Group. Interest may be paid or accrued, which means it could be paid up front, or the client can service interest, or they can defer it, so they don't need to come out of pocket any interest. We have fixed rate options available, and the client can retain their capital for investment opportunities. Let's look at an example. $50 million estate, one child. They have their full exemption left. Purchasing life insurance will give them liquidity regardless if they need it for estate taxes. Now, I mentioned $1 million net worth is really our minimum threshold. We see a lot of $50 million estates. We like to stay, if we can, between 10 and 30, 10 and $40 million. Those are really good figures for us. But we have absolutely no problem going lower than that. $1 million, $1.5 million. And really, in the materials section of this website, you'll see a trial application. So that really is the first step to getting a pre-approval. Send in the trial application with the client information, and we can help you make a determination if that's the case or not. In this example, to buy a $10 million survivorship universal life policy, they could either gift paying $200,000 for 15 years, cumulative cost of $3 million, and reducing their estate tax exclusion to $2.5 million using the current estate tax exemption amounts, or they could borrow. We have an example of them borrowing $28,000 for 15 years, only paying $420,000, not excluding reducing their exclusion, the cost savings. If you add all this back in on the opportunity cost of almost $4 million. So there's a lot that goes into these strategies. We'll show a few case examples in the next couple of slides. Premium tax, okay, so a lot of advisors, a lot of clients don't know that there's a state premium tax incurred on funding the first few premiums, or on funding all premiums really in these life insurance policies. Some off-the-shelf products average these different state-specific premium taxes, and they charge upwards of 5%. We'll look at Colorado as a current in 2015, a state premium tax of 200 basis points. However, South Dakota has a state premium tax of 8 basis points. This doesn't necessarily matter if the premiums are only a few $100s, but our average premium is about $400,000. We max fund the policies from the beginning, put as much cash in as fast as possible, and we're typically funding 5 premiums to 7 premiums, depending on the product. So you can see how these can make a big difference. But this whole slide is show there are ways to avoid the state premium taxes, and we can show our clients and advisors how to do that. So we'll go over a few case studies here. Look at the estate planning study. So older clients, they want life insurance to have the death benefit to give to their children. This example is going to show them purchasing investment-grade insurance with guaranteed rates of return and fixed return options. The client's going to defer interest. So you'll see an example where the client doesn't pay any interest whatsoever. And this is really good for clients. It says 55 to 85, but really any client can benefit from this particular plan. This is just as simple as, do you have insurance, you're paying premiums, let me show you an option to get a bank to pay those premiums for you. And this is typically the structure. You'll see a common theme here. Life insurance trust owning the policy. Our clients, if they want to make any payments to this, they're technically going to be gifting payments to this life insurance trust. This trust is then going to pay to the bank, rather, up here. Bank is going to fund premiums through the trust directly to the life insurance company, and the bank's going to receive their principal plus interest. So anything they put in plus interest earned, their interest charged, they're going to receive either from the death benefit or cash value. And this example, they're going to receive it from the death benefit of the plan itself. So you might need to zoom in on your screen here, but here's how it works. So we have an annual premium of $953,000. We're going to be funding this premium for 7 years. Client is 67 years old. See, annual premium, I'm following my mouse here, $953 for 7 years. That's maximum non-MEC premium for 7 years. We just put as much money in this plan as possible. We're obtaining a $10 million life insurance policy. Yes, the numbers work on a smaller scale. Even at $1 million, it still works. Everything is just reduced as well. $10 million life insurance policy. You'll notice these values continue to climb. Now, we really break this down into 2 parts. We have our loan summary, okay, loan performance schedule, and then we have our insurance policy values. So, $953 goes in for 7 years. The policy is max funded. Interest rate 2.85%, increasing slightly every single year. Again, we have fixed rate loan options as well. This is the total interest charged. But you'll notice column 7, annual out of pocket. The client is not contributing anything to the plan. The client's paying 0 interest. They're deciding to defer it into the loan. And because the policy has such a discount in it, when you're funding this much premium, look at this cash surrender value continue to accumulate over time. Now, if this was an index universal life policy, we typically run this at about 6%. Okay, so we're conservative on the crediting rate assumptions here. You see these surrender values continue to climb because we put so much cash in the policy. The client's beneficiaries in any year are going to receive this. You notice it starts at $9 million. Down, climbs, all the way to $3.9 million here. What's happening here? So in any year, you take the debt this year 6 right here where it's the lowest, of $10 million and change, minus the ending loan balance. That's the outstanding loan balance. So that's outstanding principal plus interest that would need to get repaid. Client were to, so the bank's making all this money on interest that they'll receive when we repay the, and the client's beneficiaries are receiving this. So really win-win. Now you'll notice around life expectancy in the 90s that this comes back up to about $10 million. Another thing to notice is, and really the client can make any interest payments they'd like to in any given year, but another thing to notice is this additional collateral required. So it's a fully cash secured loan. Now, In the first 7 years, typically, we have collateral requirements, and they really correlate with surrender charges of the policy. See, the insurance carrier, they put these surrender charges on the policy to discourage clients from surrendering the policies in the early years. Remember, they make money when policies lapse, when policies are surrendered. They don't make money when they have to pay out large death benefit claims. However, there is a sweet spot where they like to see the policies lapsing, and it's typically after 7 years or so, depending on the insurance policy, and depending on the pricing, and depending on the insurance product, because they have to pay out commissions. Commission on this policy is likely $400,000 or so upfront. That's the upfront commission to our firm or our advisors when the policy is issued. So they have those costs, premium taxes, cost of issuance, etc. But after 7 years, those go down. Those go down some. So the client needs to pledge this in the form of a letter of credit, cash equivalent, other life insurance policies, or the like. There's a variety of options for additional collateral required. And the way we come up with this really is ending loan balance minus surrender value equals the collateral required. Look here, 981 minus, this is the cash surrender value inside the policy at 317 equals 663. And every year that goes down as the surrender charges are lifted. Then you're cash for cash. And the policy supports itself. Client got millions of dollars of insurance without having to pay thousands and thousands of dollars for on the front end. This can apply to any age. 67, it could be 47, it could be 27. We may be able to repay the loan from cash value earlier on in the earlier years, but it's really specific to the client itself. So this is one way we can apply our concepts here at the Berkridge Group to win against insurance companies, to obtain a substantial amount of insurance, and